Well, let's get to the commodity markets now with Jonathan Barratt, Managing Director of Commodity Broking Services. Still with us is Steve Johnson from The Intelligent Investor and Sri, our own resident commodity reporter in Singapore. Jonathan, it certainly seems as if a lot of the commodities are bouncing around the top end of their recent ranges. What does that tell you? Is there the possibility that they're just not going to be able to break above and they might even go back down?
Mandy, we're frustrated with the prices. They just tend to go up a couple of dollars, down a couple of dollars. Oil's been in this range, 79 through 83 for such a long time. Yeah. We're just trying to work out when, in fact, it will break. And I think the evidence is slowly starting to gather that it could be a bearish move and not bullish.
Why is that?
Well, when you look at it, I guess the main one is inflation, I guess, as a key. We've got benign and high unemployment in Europe and America, and we're withdrawing stimulus packages. We've got rampant and growing inflation in China and in India, and they're reducing monetary supply. So when you look at it, the picture's not that positive.
Sri, come in on this.
Jono, for oil as a leading economic indicator, though, could we see a breakout this summer? It's the beginning of the summer driving season, of course, and all the signals seem to be suggesting that demand for gasoline is starting to mount a recovery.
Look, Sheree, it is. You are seeing it, but we're still seeing that inventory data still building. And that provides me with a concern, particularly when you compare the demand for oil, I guess, throughout Europe and the US. Compared to last year, it's down 10% already. And when you think that we're coming out of this recovery process and we're comparing 12 months' worth of data and we're already negative by 10%, you're starting to develop a negative picture. You're thinking, well, where's this demand going to come from? Is it going to be summer where they're already sort of factoring in this demand? But at the moment, we're at crossroads because we just can't see where it's going to come from.
Jonathan, I've read some really interesting statistics about gas in the US as well, and we've got our own little coal seam gas boom going on here, but around the world, unconventional gas is really booming, and I saw an estimate that there's more than 900 trillion cubic metres of this stuff in shale as well as coal seam gas. Do you think that has the potential to have an impact on the oil market and the coal market and all sorts of things as well?
Absolutely. That's one added thing I think which the market will start to focus on. If you look at natural gas, where it's come from, close from 12 down to 3.97 last night. Now, that's telling us that there's more natural gas out there and it's cheaper to produce. And I think what you will find is the demand for that will pick up because it's a cheaper alternative, and that will also perhaps hurt the price of crude oil.
I guess we shouldn't, therefore, by the same token, be discounting that big deal we saw earlier this week with BG and CNOOC and the LNG, because, I mean, China at the moment is heavily reliant on crude oil and coal, isn't it? But it just wants to make that cleaner, greener natural gas much more of its energy mix.
Mandy, not only that, but also cheaper.
Yeah.
This is one of the big things because it's a cheaper alternative fuel that we actually have at the petrol bowsers now. Well, not the petrol, but the gas bowser. You're going to go in and you can get your gas there.
The network's already there.
Absolutely.
Yeah.
So it makes sense for governments to go that way because it is cheaper and it's not as volatile because 40% of it doesn't come from OPEC.
Jono, is it almost inevitable for the iron ore market to move to a more flexible standard for pricing?
Oh, sure. I think that is certainly something that's been out there in the market. It's something that I think will occur. It just has to. Because when you come down to the volatility which we've seen across the board in all commodities, I think it's a standard. You need to be able to switch from an annual pricing to a quarterly pricing to spot pricing when you see the need, when the consumer needs to see it. The consumer can do it, but also from a producer. The producer needs to be able to lock in prices as well. So I really think that flexibility, we do have it in some of the base metals, in all the base metals, and I think it will come.
But if you look at the current pricing situation in iron ore, it really favours the producers, not the consumers. So it's in their interest to try and resist any move towards a more flexible pricing system. I mean, clearly, an annual contract locks in one price for the rest of the year, so that's good for them.
It certainly is, but when the market starts to change, it might not be as good for them. So basically, the shoe changes the foot, so to speak, in terms of where the price for the commodity is.
I just want to quickly get your thoughts. So we've got these flashes, Steve, from Santos. It sold its Evans Shoal interest for up to $200 million to Magellan Petroleum. Do you have any thoughts on this in terms of what kind of price action we might see today when the market opens up?
I don't know that that'll be a huge deal for them. I think they're very, very focused on other parts of their portfolio, so I wouldn't expect it to have a massive impact, Jonathan.
No, really.
What are your calls on Santos at the moment?
Look, I think it's quite an attractive play if you're interested in this space. I think that the energy commodities, for me, are a more attractive place to be long-term than in some of the base metals, because this supply-demand scenario that we're talking about in oil, it's also taking place in the base metals. I mean, the copper stockpiles are going up and up and up, and the price has also been going up. So I think it's very, very difficult to predict at the moment, but I'm giving the whole sector a bit of a wide berth.
Got it. Sri?
That said, Steve, can you put your finger on the next takeover target potentially in the coal seam gas area?
Not really. I don't have any idea. I think we will see more of it because prices are low at the moment and these companies need an extraordinary amount of capex to develop the projects that they've got on the slate. They're going to struggle to get that from public markets. It's a good opportunity for the big established players to come in and say, look, we'll provide the capital, but we're going to take you over. So I think we'll see more of it, but I wouldn't say that I'm any better placed to predict who that's going to be than anyone else.
We've got to leave it there for the moment. But Jonathan, thank you very much for your time. Jonathan Barratt from Commodity Broking Services, and we'll get back to Steve very shortly.